Okay, thank you very much, Kathryn, for the introduction. So again, the title of the paper is How Important is Moral Hazard for Distressed Banks? This is a joint work, again, with Zai Ben David and Renee Stulls, both from Ohio State. Before I begin, I have to give the standard disclaimer that the views expressed are of the authors only and not of the FDIC or the government. Moral hazard, again, refers to situations, of course, where a party makes choices about the levels of risk to take, but doesn't bear the full cost if things don't go as expected. And theory suggests that government safety nets could create very strong moral hazard incentives in troubled firms, including banks. And this, in turn, incentivizes banks to avoid deleveraging and to also potentially pursue risky investment choices. And now such incentives have sometimes been characterized in the literature as incentives to gamble. And this characterization is actually commonly held in some of the historical banking literature. For example, Frixis et al. Write that moral hazard and gambling for resurrection are, quote, typical behaviors for banks experiencing financial distress. So an important question is, are these behaviors really typical? Because existing empirical evidence is mixed, as many factors such as regulation, manager risk aversion, et cetera, could limit these incentives. And so as a result, the overall net effect remains an unsettled question. And that's where we hope to try to contribute in this paper. So what we do is we explore in a systematic fashion whether the behavior of distressed banks is consistent with these two alternatives, deleveraging or greater risk-taking. We focus on banks surrounding the S&L global financial crisis because they witnessed substantial bank financial distress. And the main findings are threefold. We found that distressed banks decreased their leverage, and they made efforts to shrink their balance sheets, both on the asset and liability sides, and that we don't observe that they increased risk-taking. So overall, the results suggest moral hazard incentives do not drive the distressed bank behavior for the average bank. So very quick rundown of the theory. So highly leveraged banks have incentives to not decrease leverage or increase risk because they don't bear the full cost due to government programs such as deposit insurance, because they have little at stake. And in additionally, because their debts are so large, even positive NPV projects might be avoided even if they're relatively low risk because all the gains go to shareholders. These models have in common the idea of moral hazard. And other theoretical works subsequently developed have similar ideas. We discussed some of those in the paper, but they all point to this general idea. And many, but not all, are focused not on banks, they're focused on other firms, but the arguments readily apply to banks, as pointed out in Madi's 2014 piece. Of course, the point of our paper is that there's obviously limiting factors. Banks may find it suboptimal to engage in such behaviors for a variety of reasons, including preserving managerial reputation, risk aversion, avoiding the possibility of runs. Bond covenants may limit their actions. They may want to simply preserve franchise value. In addition, regulation may limit risk-taking directly through capital requirements by preventing the gambling narrative from unfolding. So by that I mean they could actually prevent banks from bidding up deposits, which could prevent the whole standard narrative from occurring. They could also want to avoid regulatory interventions because they're costly and take preemptive measures to avoid it. So in summary, regulation, in addition to numerous forces, are likely to incentivize banks to delever and de-risk rather than gamble. So evidence, a lot of it in the US is based on the S&L crisis. A very short summary of this evidence is that increased competition and reduced bank charter values gave banks incentives to gamble, and fixed premium deposit insurance incentivize depositors to fund these banks regardless of risk. The related literature suggests that there were limiting forces. Uninsured depositors forced such banks to pay a premium, which resulted in some degree of market discipline. More recent evidence is from a variety of contexts and is also mixed. There's some support for gambling behavior for banks in Iceland. There's some support for the view that some Italian banks gamble, but others don't. Levine suggests that countries with stronger regulation systems have less of these incentives. There's support that for the view that some of these behaviors increase in the run-up to the GFC in terms of paying out excessive dividends. The last two papers aren't focused in banking, but the first one talks about de-risking for risky insurance firms, and the second one talks about highly leveraged firms aggressively deleveraging rather than increasing risk. So this gets us to what we do. We consider two periods, 85 to 94 and 05 to 15. There's a large number of banks and bank quarters. We have a large set of controls, both financial and non-financial. Our distress indicators are based on Z-score and equity capital. We use them both, but the main measure in the paper is actually the intersection of these. So it's the intersection of bottom 10% of low Z-score and bottom 10% equity capital. The main tests that we look at are to address the questions of do distressed banks deleverage, and if so, how do they do so? We estimate the following models. Basically, we look at the evolution of equity capital ratio over 4 quarters and various balance sheet items over 4 quarters. The measures are listed here. I won't discuss any of them in detail, but there's a variety of things from the asset side, liability side, and a few equity components. We use 4-quarter change because it's potentially less noisy relative to 1 quarter. A few technical notes here, and I'll skip so that I can get to the results right away. So this is the only regression table that that is part of this presentation. And this summarizes the main point that distressed banks improve their capital ratios, and they do so by roughly similar amounts each period. So in the first and second period that we look at, distressed banks had higher equity capital ratios of about 0.87 and 0.8 percentage points. That number is both statistically and economically significant. There's somewhat less deleveraging in each of the crisis periods, especially in the latter one, but that's mitigated to some extent or a large extent by banks that receive TARP. This is a graphical summary of those same results, but all we do is we replace the crisis indicator with the yearly indicator terms for the interactions. Main takeaway here is simply that deleveraging occurred throughout each year of both samples. The plot also points out that there was a sustained increase in deleveraging after Fiducia, which we posit is likely driven by more stringent regulation. We didn't find any similar evidence of an increased or a clear increase after the GFC. The next set of results refer to assets and liabilities. I'm not going to show the regression table here, but basically we find that distressed banks had lower asset growth rates with respect to total assets, loans, and fixed assets. As you can see, they declined about 8%. I'm talking about assets and loans in both periods. The yellow, by the way, denotes statistically significant results. Most of them are. We also saw reduced branch and employee growth in both periods, decreased employees and salaries, reduced liabilities and deposits, and lower deposit rates on average. Main point of this is that despite substantial differences in the two periods, the response to distressed banks appears remarkably similar, which is kind of astonishing. Just a quick note that we didn't find a big difference in the S&L crisis period with respect to deleveraging, and there was a sharper reduction in various asset liability indicators in the GFC. The TARP impact was mixed, and I won't spend much time on that. Looking at the equity components, again, the actual regression tables are not reported, but just a summary of the results here, we find that the levels of common stock equity as well as the likelihood to increase common stock equity was higher in both periods for distressed banks, as was that for preferred stock equity, although those results were not significant for the second period. And banks in both periods sharply reduced their dividends. There were some mixed results for the crisis and the respect to TARP. And I guess I don't need to spend too much time on that. Looking at the last set of tests, the results thus far document that distressed banks deleverage, and that's consistent with capital preservation and reducing risk. However, it doesn't rule out that banks could delever and still gamble with a smaller portfolio. So say the remaining assets were much riskier. So the way we test that is use the similar model. We look at evolution of risk over 4 quarters using the following 4 measures. The basic idea here is if distressed banks increase their risk, we should be able to pick that up in these measures. Caveat, of course, is we can only measure the risk that we can see, and if banks are increasing their risk in ways that's not observed to us, then that could be an issue. But we think that's an issue that all papers address, and hopefully these 4 measures capture most of what could be happening. So looking at those results, we find that distressed banks do not have increases in risk conditional on controls. In both periods, Distressed banks have higher Z-scores. They have improved, or at least not worse, performing loan ratios. They reduce their earning volatilities, as they did to the risk-weighted assets to assets. You should note that some earlier evidence suggests that loans to managers and shareholders is a potential way where banks may increase their risk. Some earlier evidence from the earlier crisis suggested that there was a lot of insider dealing related to bank failures, but we find no evidence that loans to executives increased for distressed banks. In fact, they declined. Then I'll skip the impact of the crisis in TARP, interest of time. So just to conclude, we find that distressed banks deleverage on average and do so on all parts of the balance sheet. They have lower observed risk, 1, 4, 8 quarter horizons out. The results are robust. I didn't have time to show the additional tests, but they hold for different types of banks, both public and non-public, both small and large. We also looked at a subset of results, excluding banks that were breaching prompt corrective action thresholds. And the results were qualitatively similar, suggesting that results aren't entirely driven by regulation. So overall, results suggest deleveraging is a behavior for distressed banks on average and consistent with moral hazard stories suggesting otherwise. Now, with respect to policy implications, given COVID and the pandemic, we have to be concerned about possibly of things getting worse, bank distress and failures in the not too distant future, and we need to stay aware of the potential for more hazardous banking due to government programs. For example, some have come with federal guarantees under certain conditions, like the PPP program. Our results suggest that the typical distressed bank focuses on capital preservation and deleveraging. They don't engage in this behavior, however, because bad apples exist, regulatory actions such as those that require deleveraging for risky banks continue to be important to mitigate moral hazard. Thank you very much.